Global pension viability is fundamentally breaking under the unprecedented pressure of rapidly changing population demographics across the world. This chart shows the United Nations revised population projections over the last half-century. We are seeing a steep decline in youth dependency rates, colliding with a rapidly rising elderly dependency rate. They intersect right here. The consequence of this demographic inversion is a mathematical bottleneck. A progressively smaller base of working adults must now generate the economic output required to support a disproportionately massive cohort of retirees. During the industrial era, the defined benefit, or DB, plan worked smoothly. The system relied on perpetual corporate growth and a high ratio of contributing laborers to easily fund payouts for a small pool of retirees. As the population aged, that ratio inverted. The traditional defined benefit model collapsed under its own weight, saddling corporate balance sheets with volatile funding liabilities that they could no longer accurately hedge against. Corporations responded by abandoning DB plans entirely. They shifted to defined contribution, or DC systems, like the 401k. This successfully and legally shielded corporate sponsors from absorbing any future investment losses or longevity risks. However, it did not eliminate those risks. It merely transferred them directly to individual workers. Individuals lack the institutional scale to hedge against sequence of return risks, meaning a market crash right before their retirement date can permanently destroy their capital base. The transition from DB to DC served as a highly effective corporate liability shield, but it failed to allocate systemic risk efficiently. To resolve this, we have to look at a third option: the collective defined contribution plan. This four-vector matrix compares pension architectures: funding, management, risk, and output. Looking at the traditional DB column, its defining characteristic is the strict legal promise. The employer guarantees a fixed monthly output to the retiree for life, bearing all the investment risk. Because DB output is legally fixed, inputs must be elastic. If markets drop, required funding violently spikes. In the opposite extreme, the 401k DC plan, employer input is a flat percentage. The individual bears all risk, taking benefits as a lump sum. This creates massive inefficiencies. Individuals pay retail-level fees, engage in amateur asset allocation, and lose institutional diversification. More critically, DC plans force retirees into longevity guesswork. Without knowing exactly how long they will live, they either deplete their capital prematurely or unnecessarily underconsume to protect their savings. Optimizing the pension trilemma requires breaking these rigid bundles. We must identify a structure retaining the actuarial efficiencies of a DB pool without generating volatile funding liabilities that destroy corporate sponsors. The CDC model sits firmly between these extremes. In funding, the CDC mimics a 401k. Employer obligations are strictly capped. In management, the CDC adopts the DB approach. Individual accounts are abandoned. Assets are pooled and professionally managed, opening access to institutional diversification. This allows for longevity risk pooling across an entire cohort. By aggregating the capital of thousands of participants, the fund distributes income based on average life expectancy. In the final vector, benefits, the critical trade-off occurs. To achieve pooled lifetime income without a guarantee, the payout must be a flexible target, an ambition, not a hard promise. Removing that hard corporate guarantee reverses the severe drag of regulatory overhead. The fund no longer has to purchase expensive commercial insurance wrappers or pay massive premiums to entities like the Pension Benefit Guaranty Corporation. The CDC operates by substituting the inflexible legal guarantee of a DB plan with a highly probable statistical expectation generated by scale. To understand the vulnerabilities of this math, we can look at its real-world application in the Netherlands, which operates a mandatory national defined ambition system. This flow model illustrates the Dutch system. Uniform accrual. Every participant accrues the same benefit rights at the same contribution rate. Because younger workers' capital compounds longer, they mathematically subsidize the immediate payouts for older participants. This intergenerational cross-subsidy functions smoothly during a protracted bull market. In a severe downturn, it turns into a zero-sum conflict. Following the 2008 financial crisis, that shock arrived in the Netherlands. Plunging asset values drove funding ratios below critical benchmarks, legally mandating the creation of multi-year recovery programs. The brutal mechanics of a Dow recovery are purely mathematical. The fund must raise employee contributions, freeze cost of living adjustments, or directly cut nominal benefits. When these actual benefit cuts were executed, it devastated participant trust. The reductions arrived as an unwelcome surprise to a population expecting a guarantee, exposing a deep misunderstanding of how risk was distributed. Systems relying on uniform cross-subsidization depend on two conditions to survive: perpetual mandatory participation of a younger workforce and absolute transparency regarding downside risks. In response to these vulnerabilities, alternative approaches emerged in North America, specifically shared risk plans in Canada and variable DB plans in the US. This diagram illustrates their foundational philosophy. The benefit is divided into two distinct layers. The bottom layer is the guaranteed base, utilizing hyper-conservative actuarial assumptions to ensure the employer's funding requirement remains highly predictable and secure. The top layer is the ancillary tranche, housing cost of living adjustments and bonuses. This tier acts as the system's shock absorber, expanding during rallies and contracting during recessions to completely insulate the base. These plans operate on predetermined triggers. If the funding ratio drops below 120%, ancillary benefits are automatically paused by the algorithm, bypassing subjective boardroom negotiations. By utilizing this variable top layer, funds build massive reserve buffers during strong economic cycles, actively hedging against the sequence of return risks that dismantle individual 401ks. By separating the ironclad guarantee of a base from the ambition of a cost of living adjustment, these hybrid plans isolate the mathematical advantages of pooled risk while neutralizing the threat of corporate default. As this line graph illustrates, the primary threat to the CDC framework in the U.S. market is psychological. It is known as expectation creep. The psychology is straightforward. If investment returns run consistently strong for a decade, participants naturally tune out the caveats. They begin treating the inflated, non-guaranteed target as a rigid legal entitlement. This creates an intense legal hazard. When an eventual market correction requires a benefit cut, the gap between specific legal terms and calcified expectations inevitably triggers aggressive class action litigation. The secondary hazard is structural. Attempting to convert an existing legacy DB plan into a new CDC or composite plan introduces immediate friction. A new CDC risks absorbing fresh employer contributions, starving the old legacy DB plan of necessary capital. This creates a dangerous scenario where younger workers are essentially abandoning the underfunded liabilities of the older cohort. Running these parallel systems without breaching intergenerational equity requires an extreme degree of regulatory and fiduciary oversight. The ultimate failure point of a collective defined contribution plan is not mathematical, it is operational. The architecture demands an exceptionally high degree of administrative transparency and honest brokering to prevent the illusion of certainty. As this animated curve illustrates, demographic aging and market volatility have structurally broken the traditional single-sponsor guaranteed pension. Collective defined contributions do not magically generate higher asset yields, nor do they isolate participants from macroeconomic risk. What they actually achieve is the optimization of risk allocation. They provide the institutional scale required to utilize mortality credits and sequence of return smoothing, tools that simply do not exist in individual retail accounts. The success of this architecture relies entirely on abandoning the fallacy that lifetime income requires a hard corporate guarantee. As the global dependency ratio inverts, transitioning toward collective risk sharing has become a structural requirement for maintaining national economic solvency.